Yeah, welcome again. After looking at the basic information about the CRDB's medium-term note program, or the Kijan bond program, or the social and the green social and sustainability bond program, let us look at the factors that are likely to affect this specific program, but also the overreaching risks that are likely to affect investors who are going to invest in this particular program. And starting with the first tranche that has been issued. So what are the risk factors really? So risks are basically things that could go wrong and likely affect the profitability and the operational results of the issuer, and in this case CRDB. So we are going to take a look at a couple of risks, and you can take time to internalize them and understand the effect that they're likely to have individually and collectively to the value of your investment that you are going to make in the CRDB bond. So what are those risks really? So the first group of risks that we're going to look at are the systemic risks. So what are systemic risks? So systemic risks are risks that have an effect over the entire industries, over entire industries, over more than one sectors, and the risks that are related to the specific country or jurisdiction and the like. So those are the overreaching risks, and they affect industries in general. So one is the deterioration of the domestic, regional, and the global economy. Now, if you have been paying attention on what has been going on in the world, starting off, of course, with the 2020 global pandemic, the COVID-19 pandemic, you might have seen that across the 2-3 years, there have been a lot of geopolitical issues going around that have been having a considerable, substantial effect on the economies, and notable is the Ukraine war that has led to significant increase in global commodity prices, and in fact the inflation, the inflation that has come as a result. So that is one of the risks that is likely to happen in the short to medium term, and therefore has a meaningful implication on how you're going to on the way the industry, the banking industry, but also CRDB in particular, is going to generate profits, and therefore the value of its bond. So number two is the legislative and regulatory changes. Now, the banking sector is one of the highly regulated sector in Tanzania, and therefore it is very, very important that you understand that the Bank of Tanzania might, in light of the changing operating conditions, might change the liquidity demands, may change the capital adequacy demands in response to, of course, the local conditions, but also in response to the international conditions. And therefore, as that changes, that it tends to have the effect on the profitability, but also the general operating efficiency of the issuer, in this case CRDB. So it's very, very important to take note of the legislative and legislative changes, but also the legislative changes, in particular this particular note, is very important to note that The tax code might be adjusted as in response to the country's need to maybe widen its tax base, and therefore, while, for instance, this first tranche is tax exempt, there isn't a guarantee that the subsequent tranches will be tax exempt as well. So it's very, very important to remain informed on the tax code changes and similar regulated changes that will have an effect on the income that an investor is likely to generate. So in terms of market risk, so basically we're going to there are price and the exchange rate risks as well as interest rate changes. Now, specific on the exchange rate risk, so this bond program is mad currency, and there is a significant chance that CRDB is going to raise funds in dollars as well, or in euros, whichever currency is going to be chosen. And therefore, in light of that, it's very, very important to understand the effect of the exchange rate, both the exchange rate of dollar to the Tanzanian shilling, but also the cross exchange rate in case CRDB chooses to raise funds in such other currencies other than US dollars. So the adverse movement in the exchange rate between dollar and euros, or euros and dollars against shillings, will have an effect on the amount of money in terms of local currency that is going to be raised. So while we said they're going to raise 720 billion shillings, that could change if there's an adverse exchange rate changes where they say the Tanzanian shilling is going to depreciate. The amount of funds that is going to be raised is going to be far more than 720 billion shillings that was stated. So number 3 is the interest rate changes. Now, globally, interest rates have been going up in response by central banks to curb inflation across economies. Now that's understandable, but that comes at a price. If inflation is going to rise, if inflation rises, interest rates increases in this case, and therefore the funding the funding cost of financial institutions goes up because depositors will demand higher interest rates on deposits in order for their money to be meaningful over a given period of time. And therefore, the interest rate changes, and in this case, adverse interest rate changes, will have a substantial effect of the funding cost, and therefore the profitability of these banks, and in extension, the overall attractiveness of these bonds. And specifically on the bonds, when the interest rate will go up, the value of the bonds will definitely decline. But if the interest rate will decline, the value of the bonds will go up. But then, of course, what we're looking at is the possible increase in interest rates. That will have an adverse effect on the price of bonds, and therefore the possibility of generating capital gain. Now, how about the market risks? So the market risks, how about the issuer-specific risks? Now, this could be non-compliance with the laws and regulations. Maybe CRDB might find itself in hot soup against the regulators with specific non-compliance, the increase in default rate, and this refers to the increased non-performing loans over time, or the decline in liquidity, which is subject to so many market changes. And then, of course, the operational risks, which might be a result of technological glitches, and then, of course, frauds, failure to execute the strategy, the litigation against the company, and the reputational risk. So all these are the risks that are so specific to the company and the company has to mitigate these risks. For the value of the bond and the value of the investment to be good over time. Now, the program specific risks is that one, there is a call option. Now, this might not be good for investors, especially if it's called during the moment when it's not good. So so a call option means that the issuer might decide to repurchase the bonds at a given at a specific date, and that might have an effect on might terminate the income that the investors would rather expect across the tenure of the bond. That is a risk that an investor needs to understand and price in adequately while subscribing and purchasing this bond from the secondary market. And last is that not all bonds are fit for all investors, and therefore you as an investor, you need to kind of assess your your risk tolerance, but also your expectations in terms of income generation before you actually commit your funds to invest in this bond. Do you have any questions? I hope you do. Let's know what you have, and we'll be more than happy to provide you with answers.